program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us again. Let's get across what we saw overnight. Global stocks mostly higher with little market moving news, while gold continued to rise on increased trade tensions between the United States and China. Now, investors on Wall Street were focused on quarterly earnings results, with the S&P 500 and Nasdaq gaining, while the Dow was relatively flat. Morgan Stanley shares hit a record high, while Bank of America rose also after the top lenders beat Wall Street estimates for third quarter profit on deal-making strength. ASML reported third quarter orders and operating income above market expectations, lifted by booming AI investment. Meanwhile, Macquarie has sold its network of 50 data centres across North and South America to Global Infrastructure Partners and the Artificial Intelligence Infrastructure Partnership. That's a consortium including BlackRock, NVIDIA and Microsoft. And that saw shares of data centre firms rise on Wall Street. Elsewhere, shares in medical equipment maker Abbott fell following downbeat quarterly revenue. Well, President Trump has said he's considering terminating some trade ties with China, singling out cooking oil, which traders and analysts said would have little impact, as shipments had already plummeted from China over the past year. Meanwhile, FOMC member Stephen Myron has continued his push for lower interest rates, citing increased uncertainty due to US-China trade tensions, saying there's now more downside risks than there was a week ago, and I think it's incumbent upon us as policymakers to recognise that, get reflected in policy. With the change to the balance of risks, I think it becomes even more urgent that we get to a more neutral place in policy quickly. Well, the New York Fed's manufacturing survey has risen above estimates, while the Fed's beige book of regional economic conditions noted that little had changed over the September to October reporting period. US Treasury yields, they rose in choppy session there. The yield on the 10-year was at 4.04% and the 2-year advanced to 3.5%. And the US dollar index is down marginally on the day. The Aussie dollar has climbed back above 65 US cents and is currently around 65.1. Now, on the commodities front, oil prices have fallen to a 5-month low on escalating US trade tensions with China, tensions there, and International Energy Agency's prediction of a supply surplus in 2026. Brent crude futures falling almost 1% to $62 a barrel. Copper was off more than 0.5%, iron ore marginally lower at $105 a tonne, and gold has extended its record rally, pushing above $4,200 an ounce, added by trade uncertainty and rate cut prospects, and spot silver rallying more than 3% to another record. Meanwhile, Bitcoin has fallen back below 111,000 US dollars. Well, let's get across what we're seeing on US markets at the moment, and I caught up earlier with Sam Stovall. He is the Chief Investment Strategist from CFRA Research.
There's an old saying that stocks tend to pop after a drop, and we certainly got that drop last Friday, but the market seems to be wanting to work its way higher and not digest the gains that we had benefited from in the many weeks before. So it looks as if the upward trend will remain our friend, at least for the time being.
What threat is posed by, well, you've got obviously a number of issues at play at the moment, not the least, of course, being those trade tensions with China, but also the government shutdown, which shows no sign of ending.
Well, I think investors are more afraid of a potential increase to the trade tensions between the U.S. and China, primarily because it would have a deleterious effect on our economic growth. Bull markets don't die of old age, they die of fright, and what they're most afraid of is recession. And so an ongoing trade war with China could not only cause our economy to weaken, but at the same time could increase inflation. But as it relates to the government shutdown, I think a lot of people are cynics from the standpoint of saying that the market has done very well. The last time we shut down was back in 2018 and into 2019, 35 calendar days, yet the market was up 10.3% during that time frame and up another 5% in the next 30 days. So Wall Street seems to be shrugging it off.
What are you seeing in terms of perhaps potential consolidation there, and also what we're seeing in terms of market breadth?
Well, I think that we are due for some sort of digestion of gains. History tells us that once we have recouped all that we lost from a correction, meaning a decline from 10 to 20%, the market then advances around 10% over a 4-month time frame. Well, we were up 9.5% since the end of June, so pretty close in terms of the amount that we have gained over that specific time frame. Valuations are looking a bit stretched. The S&P is trading at a 42% premium to its 20-year average forward PE estimate, and technology is trading at a 63% premium. So it does look as if either earnings need to improve dramatically or we need to see a resetting of the dials.
Now, of course, Sam, quarterly earnings season is underway. We've already heard from a number of the large banks. What have you seen so far?
Well, we're also in baseball season here, and I think the banks hit the ball out of the park. Every one of the major banks beat and quite a bit on both top line and bottom line. And instead of the financials getting 8.9%, which was the end of quarter estimate for the third quarter, now it's 13.5%, and that's just with the big banks reporting. We're going to get regional banks tomorrow, and then many other participants of the financial sector over the next several weeks. So I think that is something encouraging for investors as we look to the whole S&P 500. Actual results have exceeded end of quarter estimates in 64 of the last 66 quarters, and we could probably add another one fairly soon.
What is the impact likely going forward for the banks, particularly with the prospect of further rate cuts to come?
Our expectation is it will still be pretty positive. We have an overweight rating on the financial sector in general and many of these larger banks in particular. And when we saw most recently that instead of getting a 14% increase in third quarter earnings, now that is up to 21% for the third quarter, I think that spells some pretty positive numbers, double-digit gains for this year and heading into 2026. So I think the banks and financials are in their sweet spot right now, particularly with the potential for 2 more rate cuts, one in later this month, but also the second one in December. And then we're anticipating 2 more rate cuts in the first half of 2026, even though the Fed's dot plots are expecting only 1 more cut next year.
Now, Sam, in the tech sector, it doesn't seem a day goes past without another multi-billion-dollar deal done in regards to AI. What's your view on what you're seeing there in that sector, of course, with some concern that a bubble has formed?
Well, investors are concerned about technology because, as I mentioned, it is trading at a very steep multiple relative to its 20-year average. But I have been advised by our tech sector group head that you really can't look that far back because AI has only been around for 5 years or so. In that case, we're trading at a premium that's in the teens, not 60% or more. So that makes me feel a little bit better. Also, when you look to third quarter earnings for technology, expected to be up by more than 20% versus the 7% for the S&P 500. That is also encouraging, especially when you look to 26 and 2027 estimates, which are expected to be higher than 13% each. So I would tend to say that we still are favorable on technology in general, but we think there could be some digesting of gains of these AI companies in the near term, but still longer term, we're very optimistic on the group.
And Sam, what's your view on commodities at the moment, in particular that remarkable rally we've seen with precious metals?
Well, we do think that 5,000 is a potential target. However, we thought that wouldn't be hit until 2026. I myself sold some gold coins over the weekend, thinking that 4,000 being an elevated large number threshold would probably cause some digestion, and boy, was I wrong. So thank goodness I didn't sell all my coins. But with that in mind, I think that investors are concerned. Central banks want to own hard currency. And if the worry is that inflation might still be very sticky, then I think that's why investors are pushing up gold, as well as just the old FOMO trade, or fear of missing out.
That is the Chief Investment Strategist at CFRA, Sam Stovall. Let's come back home ahead of the market open. Pretty flat expected there, given what we're seeing with SPI futures just up some 5 points, and we'll get right across that in just a moment, bearing in mind also we are going to get some jobs numbers earlier this morning as well. Stay with us.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.